Hey, this is Sasha. Thanks for joining me in today's video. And what I want to share with you today is the covered call strategy. And I want to share with you how it works and how it makes you money, and also why it's effective for a lot of people, especially if you're just getting started when it comes to trading options. So stay tuned. We're going to cover the strategy in depth right now. All right, so a lot of people that purchase stock eventually realize and recognize they can make a little bit of more money from selling calls on it. This is known as a covered call strategy. Basically, what happens is if your stock is just kind of hanging around, not doing too much, you could go ahead and sell calls against it, meaning premium. You could go ahead and sell some kind of insurance premium to other people that are interested in getting the stock at a certain price or rate. And this is what you can do if you have this kind of ownership. Think of this as, hey, if you have and you own, let's say, a certain guitar, and you're okay to part with it as long as there's a certain price. So you could go ahead and list it on eBay. And even though maybe the normal rate or price of this guitar may be $500, well, what you could do is say, well, if I get $950, I'm okay to part with it. So it may not happen for a while, but let's say all of a sudden the demand for those guitars goes up, or all of a sudden, hey, that guitar becomes an antique because that company, went under or something like that. Now, all of a sudden your guitar is worth a lot more. And this is what you're doing when it comes to a covered call strategy. So let's break this concept in detail. But before we do, I do want to let you know you should check out my tradersfly.com website right here. And if you go ahead and take a look at that, go check out the Start Here section in the Options Trading 101. And that will help you get started with trading options and understanding options. Okay, so let's look at this covered call basics strategy and how does it work. So here I have a simple risk profile picture. Now, what does this represent? This is the stock price on the bottom. Let's say I purchased the stock at about $170 per share. Now, as the price goes up, okay, I make money. As the price goes down, I lose money. So here is our risk profile picture. So at 170, I buy it. That means I'm at zero profit and loss. Here's my profit up, profit down. So if I go ahead and I am interested in owning this stock for a long time, obviously I would just own it and hold on to it. But the problem is that stock doesn't always go up, right? That stock periodically, what happens is sometimes it stays still, sometimes it pulls back. So what can you do? Well, this is what a lot of investors do in order to make a little bit more money from holding their stock, is they sell options on it. They sell a call option on it. So what does that really do? Well, what it means is I flatten out my curve. I flatten out my profit and loss picture. So what it does is it now flattens this. Right here. So that means I can only make a certain amount of profit, meaning up to that point. Okay. Normally what would happen is you would go ahead and you would keep making all this additional potential profit if the stock price kept going higher. Let's go ahead and make that a little bit darker. If it continued to go higher, you go ahead and make more and more money. But with a covered call strategy, you flatten it out. And then you would only maximum make $1,200. So what is it that you're doing here? Well, what you're doing is, number one, in order to make this work, you need to own at least 100 shares of stock. So if you have 100 shares of stock, you can do the strategy. Then what you do is you sell one call contract higher up, okay, higher than the current price. Okay, you could sell one even lower if you want, but more than likely your stock will get called away. So what's kind of the advantage and disadvantage to this? Well, the first thing is let's say the stock stands still. Okay, now you might sell this, let's say, for $430. If the stock stands still, well, you're still back right here at your current price, or maybe even right here if it went up a little bit and then it stands still. Okay, if it stands still, what happens is you still collect the $430 and you keep your stock. Let's say scenario number two, the stock moves down. Stock moves down. Oh no. Well, what happens then? you lose money on the stock. Okay, because see, this is the downward. But you still make, the good news here, you make money from the call you sold. And you keep the stock. So, and you keep the stock. And what's about scenario number 3? Well, scenario number 3, what happens is it goes up all the way to the moon. Okay, so this is called moon money. But the problem is you sold this call contract. So you make money, okay, so you make money. So stock goes up. You make money until your strike, and then you have to sell your stock. But you make the premium, the call premium money. So you still make that 430. Now, question is, can you get out of this early? Let's say it starts moving against you. You say, hey, it's going up, but I want to keep my stock. Yeah, you could get out of it early, but it may cost you a little bit. Let's say the downside really here. The big issue with this strategy is this. Number one, it's going to protect you a little bit if the stock goes down. It's not going to protect you a lot. It'll protect you a little bit. If the stock goes up and it goes up a little bit, you're fine because you'll still get to keep your stock and you'll get to keep the premium. If it explodes, the problem is you just won't make as much. So really, your greed will have to subside. You'll still make money, but you won't make as much. Now, from my experience, most stocks do not explode to the moon. It's not typical. It's not the normal case. So that's why this is typically a good strategy. So let's say, out of 12 months, you do this 12 months out of the year, and maybe 9 or 10 of them work out in your favor and the other doesn't. Well, what happens then? Well, you take the money and then you just buy more stock and you keep doing this process over and over again. So you could continue doing this strategy if you like. It just really comes down to, doing the setup. So let me show you how this setup really works on the platform here. So going into the Thinkorswim platform, I'm going to go ahead and do this on, let's say Disney here. Okay, it's always a happy place. So here, let's say I have 100 shares of stock. Okay, I'm going to go ahead and tweak this to 100 shares of stock. Okay, this is our position, and this might be up or down. It might have moved up or down. Now, I've got 100 shares of stock. I could be down on the position. I could be up on the position. But now I want to go ahead and sell some premium against it. Because let's say the stock is standing around. It's not doing much. I still think and believe in the stock, but I just don't know if it's going to continue heading higher. So what I want to do is, while I wait, make some premium. So how do I do that? I go ahead and I could go 30 days out, 29 days, 36 days, 42 days, 57 days. The further the duration you go, the wider you can kind of get for the same amount of money in a way. So if you look at kind of 29 days, let's say you go to the 140, you only make 33 cents, but your time decay is fast, 40 cents or so. If I go, this is the 140, you make about 40 cents. Here, the 140, you make 94 cents. So if I wanted to make 33 cents, I could go out to the 155. So you could see here, you could make a lot more money. So if I go ahead and now, let's say sell, but the downside is you got to wait longer, right? So that's always the trade-off. So here I can go ahead and sell this single call contract. So what does that do? Well, take a look. Now, if that stock goes up, well, I still make money, but once it hits 150, that stock gets called away from me. So at 150, I still make $3,195. And you can see that right here, $3,195. So that's what I would make there at expiration. But if it continues to head higher, I still only make, the stock price is at 160, I still only make $3,195. But without that call contract at 160, I would make $4,150 or so. So you can see you'd make a lot more if that price kept heading higher. But again, do we really, in most instances, in most cases, does the stock really head that high to the moon all the time? No, that it does not. So that's why this strategy is a fairly good strategy that a lot of beginners start with. And I could go ahead and move it even tighter, where here at the 150, I make 37 cents. What if I move this to the 130? Now I make $2.19. That means $219. So you can see it does tighten this up. What's the problem here? Well, now I get called away when the stock is here rather than kind of over here or over here. So I've got a lot less room in my trade for me to keep the stock, but I make premium. So in this case, what happens? Stock stands still. Well, I still make my, let's just say it stands still. Well, look at what happens. If it stands still, I still make my 200 and some dollars. If it goes down, well, let's say it goes down to 100, okay? I lose value on the stock. In this case, it would be down $1,633, but that includes my premium. What if I didn't have my premium? Let's say the stock price is 100, okay? I would be down 1,637. That's an exact number, but without that, I'd be down, without the premium I sold, I'd be down 1,842. So you can see that premium actually does help you and protect you a little bit, not a lot, but it gives you a little bit of cushion. And then what you can do here as you take a look at this, if the stock does head higher, let's say it continues to head higher, 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 could you get out of it here and say, hey, I want to keep my stock? Yeah, you could. Or if it continues to head higher, you could get that stock called away. You'll lose your stock. If it goes way up here, you'll lose your stock, but you still make your premium. So in our case here, the premium is $219, which is $219. So you can see that right here. So if it goes past that point, $219 is still mine, but I have to deliver the stock. And that's kind of the downside. But like I said, for most people, these stocks aren't going to explode. Sometimes they'll move pretty close and then pull back. And in that case, you still can keep your stock. As long as it kind of doesn't hang out there at expiration and go really in the money, then you should still be okay. But just be prepared. If you're doing this strategy, your stock might be gone if it goes past this point at what you sell it at. But the good news is you get to make some premium on it. And then what you could do is buy those shares again and continue the process. Now, some people do this, with 500 shares, and then you could do this with only 4 contracts. So that way you keep, let's say, still some stock, right? So that's why that profit picture would still keep going. You don't have to do this with all 5 shares, because 5 contract would then balance you completely flat. Like you would be fully flat in this case. But if you just did, sold 3 contracts, well, at this point you'd get 300 shares gone, and then the other few hundred would continue. You'd still have the stock ownership. So that's another way to kind of look at it. But this is an expensive strategy to do. In my courses here, if you take a look at the Rise to Learn website, you can get there from the Traders Fly site as well. One of the courses that we're working on here is butterflies, but we just released the diagonals course, which you can really learn a lot about. It's about 20 some hours, 18, 19 hours or so. And in this course, we talk about a way better strategy that you can do here. So for example, if you look at that profit picture, I'm just going to show you an example by a diagonal where we talk about doing this for a lot cheaper than buying the stock. Because remember, if you buy 500 shares of Disney, okay, you're going to be paying about $60,000. That's a lot. That's a lot on your capital. But look at it like this. What if I go ahead and show you and tell you you could do the same risk profile strategy, invest in Disney by using a lot less capital? Well, here's the strategy that you could do. It's not going to be exactly identical, but it will be similar. So take a look. And you can use a lot less cash, and something like this will cost you only about $1,000. Now, this is the diagonal strategy. What it does is it works in a similar fashion. So if you look at this risk profile picture, you can see it works very similar. So you got this upward trend and a flat line. And if you look at the stock, of course, it works also in a similar way. Now, the stock uses way more cash and way more capital, and you can still get a dividend when you do the stock. The options you won't, but in this case, you're using a lot less cash and a lot less capital to structure a trade that's very similar in risk profile and in style. So anyways, just wanted to share that with you. And if you're interested, check out our website. Definitely go to the Traders Fly site. You can go to the Getting Started page and look at the Options 101 section for beginners. You can check out some of the products here that we have: books, courses, membership plans, and coaching one-on-one sessions as well. So anyways, thank you so much for joining me. Hope you really enjoyed this video, gave you some insight to buying stock and selling calls against it. This is known as a covered call strategy. And if you like this kind of stuff, get some of the other freebies that I have by clicking the link right over here. Of course, you could subscribe to the YouTube channel if you're brand new, or check out some more videos that we have. Thanks again, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.